Admiral Group fell 5.8% on Friday, its sharpest single-day drop of the year, after RBC Capital Markets reversed course on a stock it had recently championed. The broker cut its rating from outperform to sector perform and trimmed its price target to 3,450 pence from 3,560 pence, a small number move that carries a much larger signal. The bottleneck is not the downgrade itself, it is the reason behind it. RBC now projects Admiral's group pre-tax profit will fall 8% in 2026 versus 2025, a view that sits directly opposite management's own public guidance of broadly flat profitability. That gap between broker and management on the same set of facts is what makes today's sell-off more than routine. RBC has been watching Admiral closely. It made an upward revision to outperform earlier this year, which means this reversal carries the weight of a considered reread, not a first look. Goldman Sachs, meanwhile, has maintained a sell rating with a 3,150 pence target throughout, a position that looked too bearish while Admiral shares held near record highs. Today, the gap between the sell and the outperform has suddenly closed. Two analysts who started the week with opposing views now sit within 300 pence of each other, and that convergence is the signal worth watching.
The surface reading of Admiral's situation looks straightforwardly positive. UK motor insurance premiums rose 4.5% in the year to May 2026, according to Consumer Price Index data. After a market that lost over £1 billion per year in 2022 and 2023, prices are recovering. Admiral reported £958 million in pre-tax profit for 2025, with its UK motor division crossing £1 billion for the first time. A Met reading, Admiral is a cycle winner entering a tailwind. The buried assumption in that reading is the one RBC now rejects, that premium increases translate into margin improvement within the same reporting period. They do not. What flows through Admiral's combined ratio in H1 2026 is not the pricing it is writing today, it is the pricing it wrote in 2025. And in 2025, Admiral cut rates. The ABI Motor Price Index showed average premiums paid by customers were 4.9% lower year-on-year in Q1 2026, the smallest decline since 2025 began, but still a decline. Those cheaper policies written to win volume in a competitive market are now generating claims that erode margins precisely when the headline numbers suggest relief has arrived. RBC's revised combined ratio forecast for H1 2026 is 85.6%, up from its prior estimate of 83.6%, and above Admiral's own 84.2% reading in H2 2025. A rising combined ratio in an insurer means claims and expenses are consuming a larger share of premiums, the opposite of what a premium increase cycle should deliver. The key contradiction is this: motor premiums are rising because claims inflation is rising. The price rise is not a profit event, it is a cost acknowledgement event, and Admiral's book has not yet priced in enough of that inflation to protect margins. RBC estimates current pricing is still lagging claims inflation, and that the catch-up will not show in results until H2 2026 at the earliest.
RBC's thesis rests on a specific timing call. H1 2026 is the profit trough, and recovery begins later in the year as rate increases implemented in early 2026 start feeding through. That sequencing makes the 6 August interim results a hard binary checkpoint, not just a data point, but the moment the market either confirms or abandons that timing narrative. The evidence for the trough thesis is structural. Insurers reprice their books over months, not quarters. Policies written at the higher 2026 rates begin generating earned premium only as older policies expire and renew. RBC's own forecasts show 2026 earnings growing at 2.6% annually over the next 3 years, against management's target of exceeding the historical 7.6% average, a gap that implies the market's exit from this trough matters for long-term compounding, not just one quarter. International operations compound the near-term pain. RBC cut its 2026 pre-tax profit forecast for Admiral's non-UK motor businesses by 14%, projecting Italy at £8 million profit versus a prior £13 million estimate, and Spain at a £1 million loss. UK travel and pet were cut 25% to £12 million, reflecting Iran conflict disruption to travel claims and rising veterinary costs. What would break the trough thesis? A combined ratio in H1 above 87% would indicate pricing lag is deeper than RBC modeled. Conversely, evidence that Q1 and Q2 commercial renewal books are materializing at the new higher rates information management could provide at the 6 August results, which shorten the recovery horizon and undercut the downgrades logic. The market is currently pricing a company whose near-term earnings path is contested between two credible sets of forecasts.
The genuine counterweight to the bearish case is Admiral's track record. The company has paid dividends for 20 consecutive years with no interruptions since 2016, and the 2025 payout rose 6.77% to 205 pence per share. Return on equity stood at 53% in 2025. A discounted cash flow analysis cited in the pool values the shares at 46.9% below fair value. These are not weak hands metrics. For a yield-focused holder, the income base has not changed with today's downgrade, only the near-term earnings trajectory has been revised. The holder's check before 6 August is the combined ratio disclosed in the interim statement. A number at or below RBC's 85.6% forecast signals the trough is shallow and the H2 recovery thesis survives. A number materially above 86% signals the lag is longer than modeled, and the stock's current 3,167 pence level may not fully discounted the downside. The watchlist candidate faces a different question. The stock is trading at the low end of its 12-month range of 2,624 pence to 3,686 pence, and the RBC downgrade has compressed it toward the midpoint. Entry before 6 August is a bet on the trough being confirmed on schedule. Entry after, if the combined ratio prints badly, buys certainty at a potentially lower price. Rising premiums create the recovery eventually. The only unresolved variable is whether H1 proves the trough was this quarter or extends into H2. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.